Hey guys, welcome back to the channel. Today's video, we're going to be looking at the retirement savings account that is at least 17% better than a 401k. That is right, guys. All of these people that are putting money into a 401k might have a better option, which we're going to look at and we're going to explore today. So looking at 2024, so a little bit in the future, we are looking at the HSA accounts. Now the contributions for the HSA are going up to $4,150 for an individual and $8,300 for a family, which is up significantly from 2023. In 2023, we did have a pretty good increase with those. In addition, there's an extra $1,000 you can put in if you are over the age of 55, and the max contribution of $5,150 for individuals and $10,300 for couples. That is right, guys. You can put an incredible amount into an HSA. Now, the reason for this, guys, is there is a big tax advantage that we're going to get into. So this is really a big deal for long-term savings. That's because it is full of potential. However, the caveat to this one, guys, is you have to qualify with a high deductible healthcare plan to be eligible for the HSA account. So not everyone qualifies, where in a 401k and an IRA, a bulk of the majority of people qualify. This one you could actually not qualify for in an HSA, so it might not pertain to you if you do not have an HSA. Now, they have said in Blake Heigelman has said that every dollar in an HSA is worth 17.65% more than a dollar in a 401k. Now, again, we're going to break into this and how exactly this works, mainly because this is the tax advantage account that you're going to see the most benefit. Unlike other types of tax advantage retirement, HSA contributes and investing earnings can never be taxed. So I have an HSA through Blue Cross and Blue Shield. Anything over a $2,000 dollar amount, you can invest in the market, which again, there are specific rules that we're going to go over. And I'm going to show you exactly kind of the breakdown of how this does work. So that means you avoid paying income tax on the withdrawals, which at the current rate is at least 10%. And because the HSAs are not subject to payroll taxes either, you come at least 17% better than if you went ahead and put that money into HSA. This only goes much higher the more that you really earn. The big advantage, guys, when it comes to the HSA, the tax advantage, if you invest in a traditional 401k or an IRA, like we've always said, you get a tax advantage right away. Money you invested in these accounts are deducted from your taxable income in the year that the contribution was made. Now, that is the 401ks and the IRAs. The exchange for the upfront tax bracket you will owe when you take the money out. So we know that when you start taking money out of a 401k, when you start taking money out of a traditional IRA, you are going to have to pay the tax when you're taking the money out. If you take the money out before age 59 and a half, you also owe a 10% penalty on the money that you put in there from these retirement accounts. Now, this is where the HSA is different, guys. HSA comes with a triple tax advantage. That is right, a triple tax advantage. As with the 401k contributions, these accounts can be deducted from your taxable income. So very similar to the 401k or the IRA contributions, it is taken away from your taxable income. While in the account, the investment grows tax-free. This is one of the big differences, guys, is if you're putting money into the 401k, it will grow in that account tax-free. However, when you take the money out, you have to pay tax on it. Then when you withdraw the funds, you don't owe any tax on it as long as it goes towards a qualified medical expense. Now, this again is another caveat with the HSA. As long as it is a qualified, in quotes, medical expense, you can use it. So medical expenses, a lot of medical supplies, dental expenses, things of that nature are all covered by HSA accounts. It's easy to see why you can save a lot more money with an HSA. If you're in a higher tax bracket, you will avoid paying the income tax that is on there, which again, looking at higher brackets can go up to 37% tax bracket, which this account shields from all of it. So how to save for retirement using an HSA. Now again, we know the IRAs and the 401ks are really the retirement vehicles that we utilize, but HSAs really have to coincide with this, guys. And I cannot stress this enough. If you're eligible for an HSA, you need to be putting contributions in there. So to contribute to the HSA, again, you have to have that high deductible healthcare plan. The big thing with this is When you're putting money into the HSA, again, when you look at the covered expenses, the money is held in an account that belongs to you. And once it is in your account, you can invest it. You have to make sure, number one, guys, the HSA that is offered that you're utilizing has an investment option. You can invest in stocks, bonds, mutual funds, exchange funds. There's a lot of securities that you can stay in there, and you can have compounding returns over time within the HSA account. But again, you have to make sure that it does have the ability to be invested. There's a lot of HSA accounts that are offered through financial institutions that do not offer anything short of maybe a CD, if they do offer that. But HSA accounts that are held at most financial institutions have a very, very low return. You have to make sure it goes into the stock market, guys. Now, remember, the money is only tax-free if you use it for medical expenses, but if you're very strategic about it, it is easy to do. For one thing, you're likely to have medical bills when you get into retirement. In 2022, the average 65-year-old retired couple spent approximately $315,000 during retirement for medical expenses. That is right, guys. Let me say that one more time. In 2022, the average 65-year-old retired couple needed approximately $315,000 to cover healthcare expenses during retirement, according to Fidelity. Now, if you think about this, guys, that $315,000 has to come from somewhere. Hopefully, for a majority of people, it is coming from the investments that they put into that HSA. Because again, with the triple tax advantage that it does offer, as long as that money is used for qualified health expenses, you are getting that entirely tax-free. The contributions were tax-free. The growth is tax-free. Even redeeming it and using it for qualified expenses is completely tax-free, guys. What's more, your medical expenses don't have to be on consumerist to count with the money that is withdrawn. Over the year that you cover your expenses, make sure you save your receipts. Now, this is a big one, guys, and this was something that I did not know. The expenses never go bad that you pay for medical expenses. You could have 20 years of expenses, then in retirement, you take a very fancy vacation, you spend, let's say, $20,000 during that vacation. You can reimburse yourself $20,000 from that HSA account as long as you have tax receipts, or you have receipts that are going to match the withdrawals that you do with your HSA. So essentially, when you have a cost, if you do not pay for it with an HSA, you can save those receipts. When you get to a certain point, those expenses, again, never go bad. You can save those expenses to make a withdrawal out of the HSA. But again, the receipts have to match what you're withdrawing out of there. And you can take the money out of that HSA completely tax-free to use it for whatever you want, because you already paid those expenses out of pocket. Now, again, I don't know really the big logic behind this, why you would have, multiple years of expenses while you're not utilizing the HSA. Only thing I could really think, guys, is because you want to keep the money invested. So you can go ahead while you're working, everything of that nature, accumulate the expenses, pay for them yourself, save those receipts digitally so you do have them, then reimburse you in one big chunk all at once, as long as you are using the money again for qualified expenses. In other words, as long as you have receipts for medical expenses, you can reimburse yourself any money that you use at any time you want, because those expenses, again, do not expire by any means. So guys, to conclude, kind of putting it in summary, HSA is a really, really strong vehicle. Do I feel like it's going to replace a 401k? Not by any means. You're still going to need that retirement income, but when it comes to the expenses during retirement, this is a place you need to save a considerable amount of money. So when you get into retirement age, you can utilize the HSA for those health-related expenses. 401k as your living expenses, which is supplemented, of course, by Social Security. But overall, it is a really, really good tool to utilize. So again, guys, that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.